The break-even inflation rate is an indication of the market's outlook for expected inflation. It's the difference between the yield of a nominal bond and an inflation-linked bond of the same maturity. The Treasury Inflation Protected Security, or TIPS, is a Treasury bond that is indexed to an inflationary gauge, typically CPI. Normal U.S. Treasury securities do not initially take inflation into account, so the yield must compensate investors for future inflation in addition to the interest rate. Since inflation is already factored in, the yield for TIPS securities equates to the real interest rate. This means that the difference between this yield and nominal U.S. bond yields is the TIPS spread and reflects the market forecast for inflation. Since TIPS securities factor in predicted inflation and are backed by the U.S. government, they are considered to be low-risk investments. If the TIPS spread is wide, this means that investors expect inflation to rise significantly. Similarly, if the TIPS spread is narrow, this reflects investors' expectations that inflation will be stagnant.